Important points I would say is the management of companies is key to making anything, whether you're conventional or Takaful, a major success. And that has to play an important role in terms of the structure and the model that companies are adopting. We've seen a number of Takaful players struggle, and as a result of that, and trying to achieve, say, the high levels of growth, the shareholders actually changed the management. So we've seen a number of new management teams in place, and their mandate is not about being number one in the market, it's more about sustainable, profitable growth. And we are seeing a little bit of that come through in the last couple of years, as Safdar alluded to, partly generated from the market conditions as well. So just to give a snapshot in terms of what's happening globally, GDP is generally down, economies are not really growing, and as a result of that, the insurance markets are quite subdued. So the growth isn't really there. There is some growth and isolated growth in some countries, but it is a tough market out there, not just for the Takaful players, but for the conventional markets globally. Everyone's completing. There's a lot of capacity. It's tough. But when we move closer to home, where Takaful markets are more present, we see that the growth rates are higher, particularly in the Asian and Middle East markets, and Africa as well. Now, these are being translated into US dollars, so in local currency terms, you'll probably see a lot more growth in these markets. And these are where the opportunities are for many companies. The growth rates are higher. So this is where we need to be, right? In Asia and the Middle East. Not necessarily so, because we've seen companies growing where growth is high. And as a result of that, their technical performance has not been great. So they set up these operations in these high growth markets. What we find after 6-7 years, it's not quite delivering the returns that they're after, and they decide, okay, we're going to shut up shop, close down the operation, sell it off, and put it into runoff. So, there is advantages. There is good economic growth in the market. The penetration rates are low, so the opportunities are there with the introduction of mandatory covers. However, on the downside, we do have a high level of country risk. The political, economic, and financial system risks in the countries where Takaful companies operate is a lot higher. So these environments are a lot more challenging. They are a lot more volatile, and some of them, particularly the GCC, are dependent on oil. You have things like high inflation and high currency risks, which are there. So I'm going to take a brief look at the UAE market. So this, I would say, is in a separate format from what Safdar represented. And it's just looking at a 6-year snapshot of the growth in the Takaful market of the UAE players. So it's clear that Takaful companies can grow, and there are opportunities there. If you look at the bottom, that's Takaful Emirat. They've grown from 2013, albeit from a very low base, 537%. I have to say, that's incredible. As a rating agency, I have to put caveats on these things. When we see companies that are growing exceptionally fast, we say, how are they managing to grow that fast in such a competitive market? And if they are growing that fast, does that allude to pricing risk or under-reserving of the book, which, maybe there could be some further problems that may happen down the road. So you've seen some companies have got steady growth, some have grown quite rapidly, but you could argue that most of these companies are very new to the market. They've been going, say, 10 years, if you classify that as new. So opportunities are there for there to pick out and grow. Maybe some are specialised in certain segments. Now, you'll see that the two largest companies in 2013, Dubai Islamic, Oman, and Salama, they're very much at a similar position where they were 6 years ago to where they are today. So in terms of top line, they haven't grown, but the other ones have caught up to a certain degree. So what's interesting is, how does that translate into the technical profitability of these companies? So here, you'll see the ones that are making money, which are in black, and the ones which aren't making money, which are in red. So nice and simple for you to understand. So when we're looking at the profitability of the book, over the 6-year period, they've generated 70 million of profit during that period, which I have to say, that's not very good in the context of when you're looking at ROEs. And you'll know the ones, Oman and Salama, whose profile hasn't really changed over that period. Yes, it's moved up and down a bit. They've lost money. at the end of it. So these were, you could say, the pioneers, the biggest, largest ones in the GCC who haven't quite delivered over that 6-year period. There's probably different reasons behind that. But there are exceptions to the case. I mean, in the previous slide, we see AD&T growing on average at 41%, not as aggressively as some of the other ones, but their profitability has been incredibly good to generate 266 million dinars over that period. You know, that has to be commended with. And Arab Scandinavian, they only converted to Takaful 2-3 years ago, so previously, say prior to 2016, they were classified as a conventional insurer. So it's very much mixed from that perspective. So looking at some of the financial ratios here, I don't know if you can see this at the back, but you'll see the loss ratios are hovering around the 60, 70, 80% mark, with the exception of Abu Dhabi National Takaful, who, you know, unbelievably have a 31% there, which is exceptionally good. And then you'll see the combined ratios. So when we look at the technical performance, you'll see over a 5-year period that most of the market is in fact making technical losses, and that is something that needs to be addressed. It's a combination of the higher loss ratios in conjunction with the higher expense burden that they have on there. And then when you're looking at the return on equity, you've got 5 negatives coming out over that 5-year period. You've got some that are making money, but they're making money from investment income rather than the technical performance. But one thing I would like to point out is that if you have the right team in place, you have the right tools, you have the right distribution, you can make it work, as we've seen with Abu Dhabi National Takaful. You don't see too many companies, let alone Takaful companies, conventional companies, generating a 17% ROE in the UAE market, and that is probably some of the best metrics that you can get there. I don't think there's too many companies that would beat that. In addition to that, it's not on this slide, but when we look at, let's say, the capital position of this company, is one of the best capitalized companies in the market according to AM Best metrics as well. So it can be achieved with the right tools and the right commitment to it, but on average, companies are finding it fairly difficult to deliver on that front. In relation, this is just a look now at the shareholders' equity that we have there. So what we want to see as a rating agency is a company growing its shareholders' equity, i.e. you make money and you don't pay it all out as dividends, and that supplements the capital base of the company, and that helps future growth of the company. And we'll see that overall, the 6-year period, the shareholders' equity of the UAE Takaful market has basically stood still. And that just indicates that the market has not delivered. There are a few exceptions to the case, and I think where we see the growth in shareholders' equity, particularly for the 2 NOR companies, NTF, NTG, a lot of that is down to a capital injection that they have had to infuse, and I think Takaful have had to put in capital as well. So if we were to take out those, the Takaful market has probably lost capital during that period. But as I mentioned earlier, I think the approach philosophy of these new management teams is different, and hopefully we will see some better results going forward. Quick look at Malaysia. So we've seen the struggles that we see on the GCC side, and Malaysia is not free of issues, but the performance of most of the companies is a lot better. You have to understand that a lot of these companies are more geared towards the life insurance side, and if they're growing quite fast, you have the new business strain and those type of things which come in. So some of those ratios may not be indicative of the underlying book that they are writing, but generally, you know, the Malaysian market is doing well. I haven't put all of the companies here, and you'll see that the shareholders' equity, albeit it's dominated by Etika and Shariat Takaful, but when you look at the other players as well, that they are growing, which means they are getting something right in that market. And the nuances of the Malaysian market are very much different to the GCC market, whereby you have a much higher proportion of life, and the business is sold through bank assurance channels. And in addition to that, you have the regulation, which is there and is very forward-looking and for Takaful companies in the market. I think when you go outside of Malaysia in the GCC, you've got different regulators there. They've all got different rules, different philosophies, and it's a very different approach market to market. I think there's a more uniform approach here in Malaysia. You've also got a number of the big global insurance group having Takaful operations in Malaysia, and they've got good understanding and traction, and they seem to make it work. So the model seems to be working better there. So just a quick snapshot. I won't go through all of these, but these are some of the issues that we see from a rating perspective. So when we look at balance sheet strength, we want to know what the regulation is in that country and what protection it affords to the policyholders. You know, we look at the permanence of the card Hassan. There are concerns over the low surplus generation, the dependence on the card, the reserve quality of a number of these companies in the market, and obviously the insufficient ReTakaful capacity that is out there. On the business profile side, you know, these companies are still quite small relative to their conventional counterparts, and they are operating in very competitive markets, and you know, there is a lack of skilled professionals when it comes to managing these businesses. Operating performance we've been through, but we still have the high wakala fees and the dependence on the card which comes through, and the over-reliance on the investment income. And won't talk too much about ERM, but the Takaful model, we believe, is a lot more complicated than the conventional model. Hence, the ERM approach should be a lot more robust. But we do find governance issues. For example, when you're looking at investments and you're looking at the two funds, you would expect the Takaful fund, the policyholders fund, to be very liquid, backed against very liquid assets. That's not often the case. So, you know, governance and those type of issues are there. So I don't want to put, say, a negative spin on the presentation, because I think there are pockets where companies are doing well. And if we go outside of, say, the UAE, I think those issues that we see there are indicative of other markets. But there are companies in Qatar Islamic, BIMB, that are doing well. But there are a couple of other ones which aren't. Similarly, in Egypt, in Jordan, you have First Insurance that are being successful. Even if you go as far across as Palestine, you've got Takaful, who have generated year-on-year robust results. And as you move to Sudan, you know, the results there are quite commendable as well. And I think the pickup in Africa is quite important, and I think they seem to be able to gain better traction than what we've seen in, say, the Middle East, in some areas of the Middle East at the moment. And that's one area I think is one to watch. Besides Malaysia, Indonesia is another up-and-coming market where I believe they are putting rules and regulations for Takaful, and that should, you know, given the nature of the population there could be a good opportunity there, and something maybe more akin to what we see in Malaysia going forward in Indonesia. I'll spend the last few minutes just to talk about some of the emerging challenges. Now, I won't go through all of this, but these are some of the aspects that are on the radar of us. We always talk about catastrophes and pandemics, but there are these other issues which we are looking at this point in time. So Safdar mentioned about IFRS 17, so I won't mention anything more about that at the moment, but you have the issue with casualty cats, so another asbestos-like scenario that could occur today. I mean, when you look at the total economic cost due to asbestos, it's over $200 billion. And the insurance cost is about $100 billion. That equates more favourably than some of the natural catastrophes that we have today. So there are a number of legal and court cases going through on, say, the phthalates, so the chemicals and stuff that are used to produce plastics, and legal cases going on with that, with BPA and those type of things. So there could be something big coming out of there. That's mainly related to the US use of, say, pesticides for weed killer and those type of things, and those products having, say, other repercussions, having, say, people getting autism as a result of using those products. So that's something big and on our radar at the moment. We also have, say, InsurTech. You know, we have innovation in our criteria now as part of our business profile assessment. How are companies using AI, blockchain, other means in terms of enhancing their pricing models, their claims management, their distribution? Is it going to give them a competitive edge over their peers over time and position them more favourably in the market? We've seen driverless cars coming in, and those type of things. And these could be a fundamental change because the motor product could convert from a personal product to a corporate style product with time. So that's another thing to take into consideration. Environmental social governance. So we've introduced this into our criteria this year. Here's just a definition of, there's various definitions out there, set of metrics used by investors to assess a company's risks, which may not be captured by conventional financial metrics with the intention of enhancing long-term returns. So there you've got a few things in terms of climate change, carbon emissions, and on the social side, the human capital, product liability. Now, there is a session tomorrow on the investment side, so I won't talk about that. But when it comes to insurance, it's not just about how are you investing your assets. It's also about how are you incorporating ESG into your underwriting philosophy and your underwriting approach. So as mentioned by Iqbal this morning with Chubb, deciding not to insure the coal industry, we've seen a number of European players. I would say the US market is a lot more backwards at this point in time. But we've seen a number of European players. I think AXA was the first one 3 or 4 years ago, which said that they were not going to insure the coal industry going forward. So, we see there's a lot out there when it comes to ESG, and this is just a snapshot of a few of the, the headlines that were out there a few years ago. And today, so you see companies investing in, say, green bonds and other things. You see companies committed to sustainability indices. Last week, Zurich sent out a message to the market about their commitment to climate change and those type of things. Now, these are being put through by the governments and being filtered through the regulators. So the big global groups in the market have to take notice and have to be seen to be doing the right thing. Whether there is an economic benefit to it, we'll have to see over time. But I think the main thing is to ensure that they are doing things in a very much reputable way. If they're not doing in that, maybe the stakeholders, the companies, the shareholders, activists or other people that are there may create a bad name for the company. So they need to look at all avenues, not just the investment side when it comes to ESG, all, say, stakeholders, parties, the underwriting process, in order to ensure things are covered effectively. Now, this one may wake you up a little bit, this slide. So climate change is very much on the radar. And I don't think we go a day without hearing something about climate change and the commitment to climate change. So we are seeing global warming, and what is this doing? Temperatures are rising, lower snow cover, the oceans are getting warmer, the glaciers are retreating, etc. So what impact does this have on the insurance markets? Well, it's probably making the more extremes apparent, and this is what the insurance companies, the insurance world, have to contain with. We will likely to see more extreme, say, earthquakes, wind events out there, famines, droughts, those type of things, and they may be more severe and more frequent going forward. In terms of what insurers are doing, well, it would help if you've got flood risks that we don't build on floodplains and those type of things. So there is that encouragement to governments to lobby to say we need to build things in the right place, have better land use, have stronger building codes, better plannings, and at the end of the day, we need to insure these risks, and there is a price to that risk. And sometimes, if these things become too severe, there may be certain exclusions to them. Finally, another big one which is on our radar is cyber risk. So this doesn't really relate just to, you've got a full list of there what it relates to, theft of intellectual property and those type of things. But what I would say is this is a very big unknown risk to the market. It may be on policy wordings and covers, and companies don't know about it, so you have the silent cyber covers. As long as it's on their reinsurance contract and it's back to back, then there's not much of an issue there. The UAE is second most exposed to cyber threats in the world, which I don't know if many people knew that, but according to latest research. So that's after the US, and I think Germany's in third place. And we've actually seen some very small cyber threats to some of the local insurance companies in the UAE market as well. So it's something which needs to be taken seriously. We are seeing companies taking out cover for cyber from the insurance sector, less so providing cover to other ones, maybe on, say, cedents on a more select basis. But, you know, the estimated loss of a cyber could be substantial. Now, insurers are mitigating that by providing low limits, but it is gaining additional traction into the market. So that's all I wanted to say, to give you a snapshot of what our views are of what we see within the Takaful market and some of the key things that we are looking at and considering from a ratings perspective. Thank you.
Thank you. Okay, we'll hold the question and answers later. So, Brother Omar, would you like to take the rostrum or you want to speak from there? Yeah. Go ahead. We'll be speaking in the context of the African market challenges.
Yes.
Okay, go ahead.
Yeah, good afternoon. Yeah, talking about Takaful in Africa actually is very interesting because Takaful, as known, is started from Africa. The idea was started from Egypt in 1964, spread over. After that, it was a lot of discussions about Islamic insurance, if insurance is halal or not, Sharia compliant. And that was started with the idea of the first Takaful policy issued in Egypt in 1964. And after that, for economic and internal development, the idea stopped there. But it went around, and the first Islamic insurance company was established in 1979 in Saudi Arabia, and at the same time, another company in UAE. But the Islamic insurance started from there, and it was